Welcome back to the deep dive. We're jumping straight into some critical intelligence gathered just recently. It was at the Associated General Contractors of Utah's annual economic forecast event.
Right. This was a big one. You had over 250 construction executives there, all trying to figure out the path forward in what feels like, well, a really unpredictable market.
Absolutely. And our source material today comes directly from the key presentations there, so we get to synthesize two really important perspectives.
Yeah, you had Ken Simonson, he's the chief economist for AGC of America, giving that big national picture.
And then Robert Spendlove, senior economist at Zions Bank, focusing more on the macro financial side, but also the local Utah context. Two distinct views.
And, before we get lost in all the numbers, and there are a lot of numbers, from job growth to, like, copper tariffs, we should probably frame this with the core metaphor Robert Spendlove used.
Oh, yeah, the fog bank. That really stuck with me.
It perfectly captures it, doesn't it? He was saying there's this underlying optimism, you feel it, especially here in Utah with the growth we've seen.
Yeah.
But the clear view you need for making those big multi-million-dollar strategic bets, it's just obscured right now.
Totally fogged in. Conflicting data, political uncertainty, the Fed doing things we haven't really seen before.
Exactly. So our mission today is basically to try and cut through some of that fog. We'll use the specific data points from both Simonson and Spendlove.
And hopefully give you, the listener, whether you were there or not, a really comprehensive recap of the challenges, but also the resilience they talked about.
Sounds like a plan. Where should we start? Simonson's national outlook.
Yeah, let's start there. Ken Simonson's national view. And honestly, if you just looked at the employment numbers he shared, you might think the whole national economy has already, slammed on the brakes.
It was pretty stark. He opened with what he called a discouraging picture of the overall employment slowdown.
Discouraging is maybe an understatement.
Well, yeah. He showed that non-farm payroll growth is a big, broad measure of job creation. It's just plummeted since the recovery peak back in early 2022.
We were seeing huge numbers then, right? Like 5% year over year.
Exactly. And by August of 2025, he showed it was barely above water, less than 1% year-over-year growth. That kind of steep drop, that signals a massive cooling across almost every sector.
And construction isn't immune, even with those backlogs everyone talks about. He showed construction job growth has really tailed off too.
Sharply. Hovering at just, was it 0.7% growth?
Yeah, 0.7%. But he made a crucial point. That overall number hides a really big split within construction itself.
Oh, absolutely. This is critical for anyone listening. When you break down the data, you see the impact of high interest rates biting hard.
So residential construction employment.
It's actually gone negative through most of 2025. It's contracting as housing starts fall off.
Okay, that makes sense. But non-residential.
That's still growing. But slowing down, it was at about 1.7% year over year. So you see this huge divergence.
Meaning the market for, say, home builders is shrinking, but for specialized labor on big projects.
Right. Infrastructure, manufacturing facilities, data centers. The demand for that specialized labor is still pretty tight. And that keeps wage pressure up in those segments.
Okay, speaking of tightness, Simonson also dug into the JOLTS data. That's the job openings and labor turnover survey.
Yeah, that gives you insight into what employers are thinking, their intentions. And the signal there was really clear.
Which was?
Firms have basically hit the pause button on going out and hiring new people proactively.
How did the numbers show that?
Well, the job opening rate, as a percentage of the workforce, it fell pretty dramatically to 2.2%. And Simonson pointed out, for August, that's the lowest we've seen in 9 years.
9 years. Wow.
And it gets worse. The hires rate, people actually getting hired, was 4.3%. That's among the lowest rates in the entire history of the series, which goes back to 2001.
So openings are plunging, hiring is plunging. That sounds like classic recessionary behavior.
It really does. Usually when you see both those numbers tank, you expect layoffs to start shooting up.
Right, like in 2009. But Simonson highlighted this massive contradiction, didn't he? Something optimistic almost.
Yes. This is where the fog really comes in. Because layoff rates have stayed incredibly low. Stubbornly low.
How low?
He said it was the third lowest rate in the history of that JOLTS series.
Okay, so what does that tell us? Firms aren't hiring, but they're also not firing.
Exactly. It suggests that even though companies are maybe nervous about committing to new projects or bringing on new staff, they are fiercely holding on to the skilled workers they already have. Probably two big reasons. One, they know how incredibly difficult and time-consuming it is to replace say, a skilled welder or a project manager once they leave,
Especially now.
especially now. And two, there's probably an expectation that some of this infrastructure money or these big manufacturing projects, they will eventually come through, and you'll need those skilled people when they do.
So it's less about confidence in today's market and more a strategic bet on needing that scarce labor tomorrow.
I think that's a good way to put it, recognizing that the skilled labor shortage isn't going away.
Makes sense for construction, but holding on to those workers isn't cheap. Let's talk costs, because Simonson showed labor pay is still running pretty hot.
Yeah, definitely outpacing the broader economy. Wage inflation in construction is sticking stubbornly in that, 4 to 5% range.
How did he break that down?
He had a few key metrics. First, average hourly earnings for production workers, the craft labor, up 4.3% year over year. Solid growth.
Okay.
Second, and this is maybe even more impactful for long-term budgeting, he showed new union contracts are locking in average increases of 4.7%
Okay.
for 2 consecutive years. That's a big jump from the maybe 2-3% raises we saw pre-COVID.
That's significant acceleration. And what about salaried staff?
Still strong projections there, too, hovering around 4% raises. So the cost to staff a project, top to bottom, it's just structurally higher now, squeezing margins if you can't pass it on.
Right. And it's not just labor. Material costs are starting to creep up again, too. I thought those had stabilized.
They did, for a bit. But Simonson showed the Producer Price Index, the PPI, for non-residential inputs is rising again. It was up 2.5% year over year.
So moving away from stability back towards inflation, not great.
Not great. And this is where he really connected the dots between Washington policy and project costs on the ground, specifically tariffs.
Ah, yes, the tariffs. They're having a big impact.
Huge on specific materials. He flagged massive year-over-year leaps directly tied to trade policy, like aluminum mill shapes, up 23%.
23%.
Yeah. Steel mill products, up 13%.
Yeah.
These aren't small bumps. These are the kind of price spikes that blow up project budgets.
And it's not just old news, right? He mentioned new tariffs.
Exactly. New 50% tariffs on certain copper products. Not the raw commodity, but the fabricated stuff used in electrical and mechanical systems.
And that's already showing up in prices.
Yeah. He said it had already pushed copper product prices up 4.9% year over year.
So the risk for contractors is huge. If you bid a job based on old prices,
You could be instantly underwater if you don't have good escalation clauses. Or your client might have to scale back the project or even cancel it because the budget just can't handle these policy-driven cost shocks.
okay, so we've got high labor costs, rising material costs, tariff uncertainty. It's probably no surprise then that total construction spending has been trending down year over year for most of 2025.
That's what Simonson confirmed. And the biggest drag, as you'd probably guess, is private residential, down 5% year over year overall.
But again, there's a split within residential too, right?
Yes, important distinction. Single-family construction spending, down 2%. Painful, but not collapsing.
Okay.
Multifamily, though, apartments, condos, down a staggering 9%.
Wow, why the bigger drop in multifamily?
It's mostly about financing. These big multifamily projects rely heavily on commercial bank loans. And with interest rates high, lending standards have tightened up, the numbers just don't pencil out as easily.
Plus, they take longer to build, so the slowdown in starts from last year is hitting spending now.
Exactly. And the outlook is still sluggish because mortgage rates are stuck above 6%. Hard to make those deals work.
Okay, what about the public side? Infrastructure spending, the IJA money? Wasn't that supposed to be the big boost?
Well, public construction growth has slowed way down, too. It was growing at a healthy 10% rate a year ago. Now, just 3%.
Only 3%. That's concerning for heavy civil folks.
Very concerning. And Simonson shared a key detail about state budgets. He said more state departments of transportation, the DOTs, are reporting that their revenues are falling short of projections.
Uh-oh. That's a bad sign for future work.
It's a big red flag. It suggests we're likely to see state and local contract awards slow down even further. Federal money is great, but you often need that state and local match, and it might be drying up.
Which brings us to how different types of construction are doing. Simonson called it a checkerboard. Very mixed bag.
Totally. Highly selective. Let's take manufacturing construction. It's been a huge driver, right?
Yeah, the biggest category.
But overall spending in manufacturing is actually down 7%.
Down, huh?
Oh, well, the initial boom from semiconductor plants and EV factories, some of that is slowing as the first big phases wrap up.
Ah, okay.
Simonson noted there's a pickup in other specific areas, like chemical manufacturing, especially biopharma plants, and also natural gas liquefaction projects for energy exports.
Oh.
So the growth is still there, but it's shifted. It's more niche.
Got it. What about power construction?
That's still looking pretty promising, up 2% year over year.
Why is that holding up?
Just sheer demand for electricity. Think about all the data centers going up. AI, it requires massive amounts of power. So investment in solar, battery storage, new transmission lines, that stays hot. It's a fundamental need.
Okay, now here's the one that really threw me. Office spending. Simonson showed the official census data had total office spending basically flat, down just 0.3%. How is that possible? We all know office buildings are struggling.
This is the perfect example of Spendlove's fog bank. That flat number is, frankly, a statistical illusion.
How so?
You have to dig way down into the detailed census spreadsheets to see what's really going on. That tiny 0.3% decline, it's completely masking a massive, explosive 30% increase in data center construction spending.
30% in data centers alone.
30%. It's staggering. The boom in building these huge facilities for AI and cloud computing is so enormous, it's completely canceling out a really steep 17% decline in spending on other private office construction.
So that 17% drop, that's the real story for traditional office buildings.
That's the reality on the ground for traditional office developers and contractors.
And Simonson had that great little anecdote about his own organization, AGC of America.
Oh yeah, that was telling. He mentioned they moved into a smaller space recently. It took about 30% less square footage.
And he has to, like, reserve a desk on an app now.
Yeah, it shows that this shift to flexible work, smaller footprints, it's hitting everyone, even the industry's own associations. The bottom line is, building new traditional office space, that market is hurting badly. The work left is mostly high-end renovations or conversions.
Okay, so if traditional office is weak, and maybe highway funding is getting shaky, what other segments did Simonson flag as particularly vulnerable?
He seemed most concerned about highway and street construction going forward. That IJA money, the big infrastructure bill funding, it just hasn't flowed from the state level down to actual local contracts as fast as everyone hoped.
And there's another deadline looming, right?
Yes, a big one. We're less than a year away from the expiration of the current highway reauthorization bill. And given how gridlocked Congress is, the risk of a funding gap, a disruption in federal highway money, is very real for 2026.
He also mentioned higher education construction being under stress, which kind of surprised me.
Yeah, you might not think of it first, but universities are facing real headwinds. National enrollment trends are down. Institutions have financial issues popping up.
Leading to projects getting canceled or delayed?
Exactly. Contract cancellations, postponements, plus things like visa issues for foreign students who often pay higher tuition. That puts financial pressure on universities too, and that translates quickly into pulling back on building projects.
Okay, so that wraps up Simonson's national picture. Slowing employment, rising costs, tariff pain, declining overall spending, but with these pockets of strength like data centers and power, and then specific worries about highways and higher ed. A bit gloomy overall.
Definitely leaning gloomy on the national front. Close to stalling, high recession risk, construction may be doing worse than the overall economy.
But now let's pivot. Segment 2. How does Utah, where this event was held, fit into this? Because Utah often seems to buck the national trends.
It really does. Simonson spent a good chunk of time highlighting Utah's exceptional performance. It's almost an unbelievable contrast to the national data sometimes.
The numbers he showed on job recovery after COVID were amazing. Nationally, employment plunged, 15%?
Huge drop nationally. Took almost 2 years for the U.S. to get back to pre-pandemic job levels. But Utah, Simonson said, it was barely a blip. The state recovered those initial losses almost instantly.
And the long-term growth.
Just staggering. Cumulative employment growth in Utah since February 2020 is 25%. That's triple the national average of 9% over the same period. That kind of resilience is baked into the state's fundamentals.
But even the Utah miracle can't entirely defy gravity, right? Simonson did acknowledge a recent slowdown here, too, especially in construction jobs.
Yes, the slowdown is real. You can see it in the monthly numbers. But again, it's not uniform across the state. He showed these really extreme variations between metro areas.
Like Provo or Leahy.
Exactly. That area saw a sharp 6% decline year over year in construction jobs. Which sounds terrible?
Yeah.
But he specifically tied that decline to the construction pace of one single project. The massive Texas Instruments plant down there.
So one mega project's timeline can totally skew the stats for a whole region.
Completely. If that project shifts from heavy site work to interior finishing, the headcount drops, and it looks like a local recession, even if other work is steady.
Meanwhile, other parts of Utah.
We're still growing strongly. Ogden and St. George saw construction employment up 3% to 4%. So demand for housing, smaller commercial projects, it's still alive and well in other parts of the state.
Now, Simonson also surveyed the AGC members there about policy impacts, and Utah firms felt the sting of tariffs more than the national average. That seems odd for an inland state.
It was a really interesting finding. Nationally, 16% of firms said tariffs caused a project to be scaled back or canceled. In Utah, that jumped to 23%.
Why would that be?
Could be a couple of things. Maybe Utah has a higher concentration of large industrial projects that use a lot of those tariff-sensitive materials like steel. Or maybe our supply chains out west are just longer and more complex, so cost shifts hit harder. Either way, it's a bigger headache for local execs.
And he flagged another policy risk, immigration enforcement. Construction is really exposed here.
Hugely exposed. He laid out the numbers. Nationally, 34% of construction craft workers are foreign-born.
And in Utah.
Still very high,
Yeah.
29%. Way above the average for all industries. His warning was pretty direct. With more resources going towards immigration enforcement, 2026 could see major disruptions to labor availability.
Especially in certain trades.
Yeah, he mentioned occupations like plasterers, drywall installers, roofers trades known to rely heavily on immigrant labor. A crackdown could create real bottlenecks.
So Simonson's national outlook, gloomy. His Utah outlook. Slowdown, yes. Policy risks, yes. But still fundamentally strong.
That was the key takeaway. Despite the national headwinds, Utah's core strength is its demographic momentum. Population growth here is 1.8%, tied for third nationally, almost double the U.S. average.
And that population growth fuels demand for everything.
Exactly. Housing, schools, roads, stores. It's a durable fundamental driver. Simonson argued that this population engine should keep Utah performing better than his overall gloomy national forecast for construction.
Okay, that's a great bridge. Simonson gives us the national storm clouds and the local silver lining. Now let's bring in Robert Spendlove from Zions Bank in segment 3. He really focused on why everything feels so confusing, the Fed, interest rates, and that economic fog.
Spendlove's perspective was crucial for understanding the macro forces creating this uncertainty. He started by asking the audience a really fundamental question.
Right, the inflation versus employment question.
Yeah. If you have to prioritize, which is it? Controlling inflation or promoting full employment?
And the construction execs overwhelmingly chose employment.
They did. And Spendlove's point was, okay, but the Federal Reserve for the past couple of years has been laser-focused on inflation.
Even though they have that dual mandate.
Right. But if the Fed's primary goal is crushing inflation, it has to keep interest rates higher than the economy might otherwise want. That focus directly leads to the higher borrowing costs that Simonson showed were hurting housing.
We did get that small rate cut recently, down to 3.9% in October, but Spendlove put that in historical context.
He really emphasized how weird the current situation is. We had near-zero rates after the 2009 crisis, and then again super aggressively after COVID. That caused this massive overheating. Then the Fed jacks rates up above 5%. Historically, that should have caused a deep recession by now.
But it hasn't. Not really.
Exactly. And the fact that it hasn't is the biggest sign that things are just distorted. The normal economic levers aren't working as expected. The big question is, when does the pain finally catch up?
The markets certainly want more rate cuts. The Fed's own forecast hinted at maybe another cut by year-end.
It did. The dot plot suggested maybe 3.6% by end of year. But then Fed Chair Jerome Powell threw cold water on that idea.
What did he say?
Spendlove highlighted the specific language. Powell said a December rate cut is not a foregone conclusion, far from it.
Oof. Markets don't like that kind of uncertainty.
Not at all. Spendlove showed how market expectations immediately shifted. The chance of that year-end cut dropped. It signaled the Fed is ready to stay tighter for longer if needed.
Which leads perfectly into what Spendlove called the unseen lever, the Fed's balance sheet. We all focus on the main interest rate, but this is maybe even more important for construction folks.
Absolutely. This is complicated, but it's fundamental to understanding why rates might stay high. The Fed's balance sheet, basically all the Treasury bonds and mortgage-backed securities it owns, exploded during COVID.
How big did it get?
From about $4 trillion pre-COVID to a peak of almost $9 trillion. That $5 trillion flood of money, called quantitative easing or QE, was designed to push long-term interest rates down. That's how we got 3% mortgages.
They weren't just setting the short-term rate, they were actively buying up mortgages to lower those rates.
Precisely. And now they're doing the opposite. It's called quantitative tightening or QT. The balance sheet is down to about $6.6 trillion. They aren't selling assets, but they're letting them mature and not reinvesting the money.
So less demand for those long-term bonds.
Means long-term interest rates stay higher. Things like the 10-year Treasury yield, which influences commercial loan rates. This balance sheet runoff is a key reason those rates aren't falling much.
And the scale of their involvement in the mortgage market was just mind-blowing.
Yeah, Spendlove dropped a statistic. At the peak, the Fed owned 1/3 of all U.S. mortgages. Even now, it's still around 25%. That level of direct market manipulation was unthinkable before 2008.
So this leads to his big point about the new normal for mortgage rates. People shouldn't expect 3% again anytime soon.
He was pretty emphatic about that. He told the audience, don't bank on rates going back to 3% unless we have another huge economic crisis.
Wow.
The reality is the Fed is trying to get back to a more normal rate environment. That probably means dealing with rates in the 5%, maybe 6% range for years to come.
Which means the whole calculation for developers, for commercial property values, for housing affordability, it all has to adjust.
It's a massive reset. It'll take years for the market to fully adapt to this higher rate reality.
Okay, that's a sobering thought. In segment 4, Spendlove shifted to Utah's specific strengths, but he also talked about how political issues are messing with the data itself.
Right. First, the good news. U.S. GDP growth has been surprisingly strong. Q2 was 3.8%. Q3 estimates were initially around 4.0%. The economy keeps defying recession forecasts.
But
There's always a but.
the government shutdown threw a wrench in things.
Yeah, that 6-week shutdown was expected to shave about 1.5% off Q4 GDP growth.
Is that growth lost forever?
Probably not. Spendlove said it likely just pushes that activity into Q1 2026. But the immediate problem it caused was meshing up the data flow. Official economic reports got delayed or weren't released.
Which makes the fog bank even thicker for people trying to make decisions.
Exactly. Especially for the labor market. With official data missing, you have to rely on alternate sources.
What were the positive signs he could still point to?
Well, the official unemployment rate before the data blackout was still very low, 4.3%. Private payroll data from ADP showed positive growth in October, especially in big companies.
And for Utah specifically?
Weekly unemployment claims here stayed really low and stable, around 1,500. That's usually a good sign that mass layoffs aren't happening.
Okay, but those sunny spots conflict with other data, right? More fog.
Definitely. Other sources showed the hiring rate slowing down. And data on announced layoffs, like from Challenger, Gray, and Christmas, was trending way up. Over 1 million announced layoffs nationally in 2025.
Highest since the pandemic.
Yep. So official unemployment looks low, but finding a new job is getting harder. And job security, especially for white-collar workers, seems to be weakening.
Spendlove then talked about two big distortions hitting the workforce, AI and tariffs. Let's do AI first. He found this huge disconnect in the room about AI use.
It was fascinating. He polled the audience. Something like 90% said they personally use AI tools in their work.
Tiny percent, okay.
But then he asked, what percentage does your employer admit to using? The average answer was only 10%.
Whoa, huge gap. Why are people hiding their AI use?
Fear, probably. Fear that if management knows how much AI helps them, they might think the job can be automated away. But it also means there's this hidden productivity boom happening that isn't showing up in the official stats.
Making the GDP and labor numbers feel even stranger?
Totally. And he cited research showing AI isn't just impacting jobs, it's impacting age groups differently.
How so?
It showed younger workers, like 22 to 25-year-olds, are actually seeing job displacement. Headcounts dropping in entry-level tech and customer service roles.
But older workers?
Older, more experienced workers, say 40 to 50, are actually benefiting. AI tools are amplifying their productivity.
So AI displaces the inexperienced but helps the experience.
It seems that way. The experienced workers have the judgment to use the tools effectively, prompt them correctly, evaluate the output. It flips the usual script where technology hurts older workers more.
Interesting. Okay, back to the other distortion, tariffs. Simonson talked about the cost impact. How did Spendlove frame it?
He called tariffs what they are. A tax. A big one. The average effective tariff rate is now over 15%.
I sense.
The 1930s Smoot-Hawley tariffs. It's a massive, mostly hidden tax hike on businesses and consumers. He estimated it's generating hundreds of billions in federal revenue.
And the constant changes make planning impossible.
Exactly. That instability is almost as damaging as the cost itself for businesses with long lead times, like construction.
Let's talk about the consumer. Sentiment is low, especially for lower income folks. But spending is holding up. How?
Yeah, retail sales growth was still pretty strong, like 4.7% year over year. But Spendlove showed how it's being financed. It's not from rising incomes for most people.
It's from savings and debt.
Bingo. The personal saving rate is really low, down to 4.6%. People are burning through savings, and you see signs of strain. Credit card balances are up. Delinquency rates on consumer loans are starting to rise.
We're basically borrowing from the future to spend today.
To a large extent, yes. And crucially, this spending isn't evenly distributed. Spendlove had a killer statistic on this.
Who's doing the spend?
It's overwhelmingly the top 10% of wage earners. People making over $250,000 a year. They account for half of all current consumer spending.
50% from the top 10%.
Yeah. So businesses catering to that high-income group, they're doing okay. Luxury goods, travel, high-end services. But businesses serving the other 90%, they're feeling the pinch much more.
That bifurcation is critical to understand. Okay, finally, Spendlove circled back to Utah's strengths, reinforcing Simonson's points.
Absolutely. Despite all the national gloom and fog, Utah's fundamentals look remarkably solid. He cited Moody's Analytics calling Utah the strongest economy in the country.
And the local stats back that up.
Big time. Employment growth 1.7%, more than double the U.S. Unemployment low at 3.3%. Wage growth strong at 5.2%, much higher than the U.S. average of 3.7%.
And that incredible median household income figure.
$104,000, highest of any state west of the Mississippi. That provides a huge buffer.
But he did acknowledge the flip side, the big challenge for Utah.
Affordability. No getting around it. Median home price here, $534,000, way above the national median, $368,000.
Even though price growth has slowed way down.
Right, appreciation is only 1.5% now. But the sheer cost, combined with those high mortgage rates, creates real stress for the workforce. It's the main threat to Utah's competitive advantage long term.
Okay, let's try to synthesize this for the construction executive trying to plan for 2026. We got Simonson's national warnings, Spendlove's explanation of the macro fog, but also the affirmation of Utah's strength.
It really highlights the core tension, doesn't it? Simonson gave you the tangible, specific risks. The housing slowdown, the tariff pain, the weak spots in office and highways. Those require immediate defensive planning, cost control, managing that supply chain risk.
And Spendlove explained why it all feels so weird and uncertain. The Fed's heavy hand on rates via the balance sheet, the political chaos messing with data and trade, this deeply divided consumer market.
So the takeaway for a Utah executive seems complex. You have to prepare for the national storm, keep your good people, maybe focus on those resilient sectors like data centers or power.
But you can also have some confidence in the underlying local strength, that unique population growth and high income, to hopefully keep Utah performing better than the rest of the country.
That seems to be the consensus. A cautious optimism, perhaps, buffered by strong local fundamentals.
And we should end with that final provocative thought Spendlove left everyone with. You know, the old joke about economists predicting 9 of the last 5 recessions.
Right. Given how thick this fog is and how distorted the traditional numbers are, what should you really be watching?
Not the official unemployment rate, he suggested.
Yeah, that's too delayed, too easily skewed right now. He said you need to watch the less reported, maybe more volatile indicators that show actual behavior changing.
Like what specifically?
He flagged 2 things. First, keep a close eye on layoff announcements in professional services and tech census, the sectors employing those high-income consumers who are propping up spending. When they start losing jobs in bigger numbers, that's a major warning sign.
And the second one?
Watch the rate of increase in consumer loan and credit card delinquency rates. Not just the level, but how fast it's rising. When that financial strain really starts biting the upper middle and high-income groups, forcing them to cut back.
That's when the fog might really start to lift, and we see the true depth of the slowdown.
That's the theory. Those are the canaries in the coal mine for 2026, the critical barometers to watch while we navigate this fog.